For an hour. Hello, everybody. How are you? I'm Martin Tobias, the managing director of Incisive Ventures, and this is another episode of The First Bet, where we talk to people about making capital allocation decisions in low information environments with lots of uncertainty. I've done that as a pre-seed investor, as a poker player, as a CEO, and we try to find the smartest people we can to talk about that. And today I have my friend Arkady, who's a deep tech VC, and I'm really interested to talk to him because he making decisions in deep tech is, I think, very different from making decisions that I do in software companies. So I wanted to welcome you, Arkady, to The First Bet.
Martin, thank you very much for the invitation. I love the chance of being here, and I'm happy to talk to you about any complicated life decisions that I made or will have to make in the future.
Yeah. So what I'd like to do is ask you the question. You tell me about one investment you made in a company, how you met the founder, what information you had. Let's start there, what size check you wrote or whatever. But let's get into the information that you had at the beginning and some of the frameworks that you used to decide to write the check, because there's a lot of uncertainty early. Maybe just, and we'll talk the whole conversation kind of around that one decision that you made.
Would you like an example from the earliest days of my VC career, or would you like an example from the freshest, from the most up to
Whichever
date?
one you want. Maybe a little bit older one, if the way you made decisions is similar now, or maybe an old one and a new one, and tell me the differences if you've learned anything and are making decisions differently now than you were maybe 5 or 10 years ago. That could be interesting.
That is exactly the idea here.
So let's talk about two of
Let
them then. Let's talk about the old one and then let's talk about a new one.
Sure,
And yeah,
sure. And I will use those. I will give two examples. One of them will be more on the kind of that didn't play out as I expected it to play out, and what kind of risks I saw and what kind of risks I have omitted and I didn't realize they were important. And I will talk about something that we have made recently, the more recent investments, and how that played out a little bit better.
okay,
I'm not going to name the company that's
it's
I
fine.
don't think is doing really well, really not so well. So
Hmm.
I'm just going to tell you this story. I get the company as I usually get it into my pipeline. I start looking at the deck. It sounds very interesting. They're trying to solve one of the critical problems around energy space in the world, energy storage specifically. And we are working together. We're doing the deep diligence on them, scientific diligence, technological diligence. We actually fly to their site with my partner. We meet together. We talk about all of those things. We spend a day with the founder and his team. We check everything out. It's a real device, real problem, real customers. We talk about everything. They make sense, and we do the investment. We underwrite the size of the problem, classics, right? The size of the market. We underwrite the groundbreaking technology. Is it there? Yes, it is there, and it is still there. And we underwrite the founders, their capabilities, their resilience, their grit. Can they deliver? Seems like everything is covered. The one thing
Yeah,
that we have completely missed is the size of a venture scale ambition that the team had, or in that
interesting.
particular case, did not have.
Hmm.
So I'm coming there with my entrepreneurial background, right? I'm an entrepreneur since I was 18, for 20 plus years at that point.
Yes.
And I'm like, is it a good entrepreneur? I'm like, yeah, for sure. Is it a solid team? 100%. The thing that I did not ask myself back then was, is it a good entrepreneur to run a venture scale business? Because, and this is a very fine distinction between being a really good and strong entrepreneur who can build a lifestyle business, like a restaurant or a hotel or something that you manage on a daily basis. And I'm 100% sure that this company is going to do really well for the founders. They're already in good revenue. They will probably hit several tens of millions of revenues soon. I just don't think it's going to be a unicorn. I don't think they will be the
I,
people who will return my whole fund. So are they going to do well? Sure. Is it going to be a good investment for me? Maybe not so sure.
so did you do that in a prior fund or was it an angel investment?
It was in a prior fund, in my
It was
previous
in a
fund.
prior fund. So it wasn't a
Mhm.
venture fund, but so something you might have learned as a venture investor is that you need to back founders that are not just good in big markets, but that have the ambition that's big enough to get in there. I've seen plenty of them where they end up. I think it's going to be a lifestyle business, and that's a hard thing. So you would have on that one wished you had spent more time on diligencing the size of their ambition. Was do you think it was related to the founder's ambition or the market's exit? Because the other side of that is it's some of these things that get built that could be good businesses may not be valued well at the exit. Like, a lot of these software companies I'm looking to that are turning into software as a services business end up being services businesses, and services businesses are trading at 2 or 3x EBITDA versus 15x EBITDA on a software business. So even if they build a successful business that's profitable, the exit multiple is not there. So in this company, was it more the founder's motivation or more the market's ability to pay for that innovation that was the issue?
I think it was more on the founder side of things. I think this is one of those situations when I think the founder would be content and happy with the outcome, even if it's not a venture scale size
Yeah,
outcome.
yeah, yeah.
And I
Because
think it's an important thing. Yeah.
they probably ended up owning most of the company anyway, like, versus the
Hmm.
venture people, right?
Hmm.
So
Hmm.
that's one thing that as venture capitalists, we need to look at. I mean, I've funded 6 companies that became unicorns, and all 6 of the founders are billionaires, and I'm not. I made less money than they did in those deals, as it should
I
be.
think it's fair. I think
It
that's
it
how it should be.
it is fair, but you need to have someone that wants to work as hard as it's going to be to make themselves so much money, because you're going to make a fraction of their money. And if they have
You,
lower ambitions, yeah. So that's one thing. So tell me about the
your
second one that you
fund
made.
your fund is going to make a fraction of their
Yes,
money,
your
and then
fund is going
you
to
as
make
a
a fraction,
manager is going to make a fraction of what your fund is going to make.
even smaller fraction of that.
You're
That's
going to get a
true.
fraction of a fraction at the end of the day. So yes,
Okay.
the ambition
So
really is important.
the way you're underwriting it was founder, team, and market, and the product, did it work? And all those things were yeses, but there was something that you missed. So tell me about your second example that was more recent and how you underwrote that one, either the same categories or different, or
I actually, while we were talking about that, I decided to give you an example around the same timeline, which I did
okay.
an investment roughly around the same time. And where I would argue people in general see that industry as more risky one. This is a medical device. This is a neuromodulation halo that goes around your head. And when people hear medical device, they're like immediately FDA regulation, like no, 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 not gonna touch it. Thank you, thank you, no, thank you. The company itself is called Farion. It's led by Blake Griffin, and we have been talking for a while before he even launched the company. I was the very first VC check in his firm.
Hmm.
The interesting part about that is that when we've been evaluating that, he was coming with a proposal to use a very specific type of magnetic wave to heal inflammation in human tissue. And they start with the brain because it's the hardest one to treat with traditional pharma and other means to treat inflammation. So I think it's a good way to start. We've done a very deep due diligence again on the scientific side of things, physics of it, neuroscience of it. A special shout out to Richard Silberstein, who led it in my firm, my scientific partner. We have spent, I would say, maybe more than 10 hours in person or via Zoom net time before we made an investment with the founder. This is very rare. We usually spend 3, maybe 4 hours with a founder before we make an investment.
So you spent about 3
You
times
know
more
how it
time.
goes.
Yeah.
Yeah. And
And why did you do that? What was it? Was it the technical challenges around validating the invention? Was it the team? What were the things that were causing you to spend more time?
it was the interpersonal connection with the founder. It was the specifics of a Russian dude trying to
Mm.
decipher the social code of an Italian American. And I actually had a conversation with Blake at some point. We had lunch in Palo Alto, I believe, and I was like, man, I sometimes feel like there is a wall of ice between us. What's going on? I can connect to many different people with different cultures, Indians, New Yorkers, Los Angelitos. Angelitos was the right name for those.
Yeah, yeah.
like different kinds of people, even somebody from Spokane, even, right? And the this was an awkward conversation,
It was
Martin. He's
awkward.
like, dude, I don't get you. You don't get me, I don't get you. How can we do business together if we cannot communicate in a healthy way? And this was something that was giving me the biggest pause. The funny thing is that this investment was done even before my previous example. So this guy has a lot of ambition. Like, this was never even a question. Like, it's very clear that he wants to build a multi-billion-dollar company, and ideally, along the way, find a way to heal people in a much more sane format. So in that particular case, I've looked into that in details, and we have worked very hard to make sure that the technology is here, the market is here, that it's a real problem, and inflammation in the brain is a real problem that
Hmm.
is persistent in many conditions, from concussion to Alzheimer's. And in that particular case, everything keeps playing out as it should be. They just finished their clinical trial. Number one, complete success. 80% patients report that everything is great. Then they're now doing the bigger clinical trial with Mount Sinai with open indication. So in that particular one, I want to say it was a much less obvious yes to me than the energy storage startup that I mentioned, because so much regulatory risk, so much technological risk, because they're doing something never done before, the specific type of magnetic therapy.
And you had
And
the
yet,
FDA, which is hard to underwrite. How did you get comfortable with the FDA risk?
well, to me, because we do a lot of stuff in neuroscience, to me, FDA is a given for many of my startups. So instead of treating it as a kind of a gate function, yes or no, I try to understand, what does the founder think about it? How do they think about it? And kudos to Blake, he had his stuff together from day one. He was very clear on the FDA, he was very clear on the reimbursement codes, which is actually a much bigger problem than people realize. Everybody's talking about FDA, but getting an FDA approval doesn't mean that you're automatically in money. You need reimbursement
Reimbursed.
codes, you
Yeah.
need to
Yeah.
work.
Yeah.
Yeah, exactly. Like, because if you lock yourself in the out of pocket situation, your revenue is abysmally smaller
Yeah.
than
Yeah.
what
Yeah.
you can get from insurance companies. So to me, this was a more risky investment by every standard. Like, just the number of risks and the magnitude of those risks was much higher. And at the same time, the ambition of the founder, his passion, his resilience, and ability to find new ways to figure out those problems, so far is working out even better than the energy startup I've mentioned.
So how did you get over your personal the we're not meshing objection you had? Did when you had that
Just the
conversation, it
conversation.
just worked out,
Just the
or
conversation. Yeah,
the
Martin,
conversation you
I'm a
had?
big believer. Yeah.
So
I'm a
so
big believer
sometimes
in
you could have an
communication.
objection. So
Just
let's
talk to
talk.
people.
Sorry, go ahead.
I believe in communication. Just talk to people openly about everything. We have the same rule with my wife. If somebody is not happy with something, we just talk about that stuff. We don't hold any
Yeah,
kind of negative stuff until it bursts in our
yeah,
faces.
yeah.
We try to make sure we talk about things openly.
So that's something, I'm glad you brought that up, because that's something that a lot of capital allocators don't talk about. They say, when you talk about, so let's move on to the case against making these investments, because every time you're presented with an opportunity to invest in something, there's a whole bunch of reasons to not do it. There's more reasons to not do it. And most people kind of pin their hats on the reasons outside them. Like, I'm worried about the FDA, or I'm worried about insurance copays, or I'm worried about those things. And you talked a little bit about those, but you mentioned that there are sometimes internal or, relationship things, communication styles that are also reasons to not do a deal that are that come up. And the way you deal with those is you just keep talking to the people, and sometimes you can talk yourself, get a better understanding from the person, but sometimes, you can try to have that conversation and the person's not open to it, and that's a reason to say no. Like, if the person, one of the things I do, for example, is I don't expect the CEO to do everything I say, but I expect them to be curious about the comments I make about their business and to be thoughtful in their responses. If they dismiss comments that I have out of hand without even considering them, that means that we're probably not going to have very good conversations in the future, you know?
That was exactly the point I was trying to make. Yes, this is a very long game. You invest in the companies at the earliest stages of their formation, pre-seed, seed. you're going to spend 7, maybe 10 years with this founder in the future. If you already start with a broken communication, this is going to end in disaster. And maybe
Uh-huh.
not a disaster, but the absolute best outcome that can happen is that, say, somebody buys out that company and you get your distributions at some point after 10 follow-ups with the founder.
Mhm.
If you already have a broken relationship and broken communication, you
Yeah.
will never know what's going on. You will never know how to help these people in the moment when they really need your help. Because you know it and I know it. When founders openly ask you about something, that's nice to have. Usually when founders really need your help, they're ashamed to even mention that on a call with you. So you need to have trust. You need to have relationship that is based on open communication and transparency. And if you have it in that particular case, then
Mhm.
you will have a successful relationship with the founder. And
Mhm.
successful relationship with the founder is the foundation of getting access to secondaries if they sell at some point. Is the foundation of getting preferred liquidity through M&A or IPO. Like, there is a lot of stuff that will translate. Let me finish. That would translate into clear monetary wins purely from having a healthy relationship with the person.
I agree, and I'm glad you mentioned that because a lot of early stage VCs or a lot of outside people looking at early stage VC might say, "Oh, he just got lucky. He picked a thing and it went up a lot of and he made some money." But you have to so let's move on to the next thing, which is
Mhm.
where did
Sure.
the confidence to write the check come from? And you just mentioned a lot of personal things that I don't think a lot of people making these decisions think about, which is my relationship and my communication style with that person. I have to get confidence that they are going to listen to me, that we're going to have a good ability to communicate. So, like you said, it's 8 or 10 years, and the spreadsheets aren't going to be what matters. A lot of times, it is that ability to just think. I think he's going to be honest with me about the status of the company, and I think he's going to be open to any suggestions that I have. When, as you mentioned, how you made the decision, you did diligence on the technical and you did diligence on the team. And so if you had to sort of stack rank or as a percentage, I know it's not a formula every time, but what percentage of your decision to write the check is those relationship and how well you think the relationship with the founders are going to go versus the other things like, can the product be built? Do they have the right team? Is the market big enough? Is it 50-50? Is it 70-30? Have you thought at all about the percentages of weights of those different things?
And you know how OCD-ish I am. Yes, I have thought about
I thought
it.
so. So tell us, please.
My investment process is broken into two different things. There is the first IC, which is focused on blockers. And that first IC, there are 6 questions that can go wrong with the team, 3 questions that can go wrong with the market, 5 questions that can go wrong with the product or technology, and 2 questions on strategy, 2 questions on round parameters. So it's like, I would say, team is the most important thing in terms of blockers. The technology and product is the secondary, and then strategy, planning, strategy around parameters, and the market size is the third layer. I would categorize it like such.
Okay.
If we don't find any blockers, then I can give you specific percentage points among 8 different parameters. So once we get to IC2, once we have collected all the information, our partners talk to the founder, we've done all the things that we wanted to do, we attribute 23% of our weight to team and people,
Okay.
around 8% to market and need. So, how big is the problem? How large is the market? 20% to the product and 28% to the mix of science, technology, and product. 15% to competition. 11% to traction, and if the case is like regulatory, then regulatory as well. And then 15% to the mix of strategy and round parameters, because we need to understand how we're going to make money as investors in that specific deal. So yes, I do have it down to a specific percentage point.
Okay. Well, thank you for sharing that because I think that is very different from what you would get from investors in software, for example. For example, like the product for me, you said yours is 28%. Mine for the product, that's more like 10%. Because my
Hmm.
assumption in software is that if you understand the customer really well, and you understand the problem really well, you can build just about anything that you want with software.
Hmm.
But in your case, can you get a patent on it? Can you even build it? How does this scientific approach compare to the three other scientific approaches people are taking to the same problem? And I have to make a bet on a particular, approach to the problem, which because I'm sure like the one you talked about, the guy doing the headset for brain inflammation, there's probably pharmaceutical companies that want to sell you a drug for brain inflammation, which is a different way to solve the same problem. There are
Hmm.
different ways to solve that problem. And you as a VC have to decide, do I think this approach, is going to get enough traction or work well enough relative to the other potential approaches, right? So that's why you have a
Exactly.
28%. Yeah. That
The we can go deeper into the split between technology, science, and product, but I don't think your listeners would be interested in that specifically. And it's very idiosyncratic. Let's be very clear. Every single VC will build a process that is tailored to their own perception of the world and their own perception of the risk. So if I have it at 28% and somebody else investing in early stage deep tech has it at 14%, they might be right for
they might
themselves,
be
and
right.
we
Yeah.
might be right. Exactly. So,
And that's fine, and that's why I'm talking to, like, 30 or 40 different people, because somebody has different things, and then people can hear, "This resonates more with me or that," but I just wanna get it from you and what you do and how you underwrite, deep tech. It was interesting when I was at Liquidity. I was talking to a couple of people, and one guy's, "Oh, venture's easy. You just apply the Harvard rule of how to underwrite, and there's only four categories. In fact, technology is not even one of them." And I'm like, that might work for Harvard in certain categories, but it's not going to work in deep tech. It's not going to work in biotech. I think you got to come a little closer. So,
I have something to say on that point, actually. I
yeah,
think it's an important distinction between software and deep tech. And I think it's a pretty straightforward thing that a lot of people oversee. They kind of shrug at it and they don't think it's serious. For any software company, you need a huge market and an
yes,
outstanding founder. The way you
yes.
define your outstanding founder is up to you. You can talk about resilience, greed, obsession, passion, doesn't matter. Market and founder should be phenomenal for you to
It's like
invest in them.
80% of the decision criteria for me.
If not 99%, right?
Yeah.
It's very important. The deep tech angle brings a separate aspect to that. It brings the aspect of technology. I will even go all the way and say science into the mix. Because if you as a founder, not as a VC, if you as a founder launch a software company and you want to develop a video game, but then the video game fails and you pivot into a messaging system, you can still become Slack and
Yeah.
IPO and become one of the biggest runaway hits of that period of time, right? Of the decade. Fantastic case of pivoting. If you're building a solar panel company and then it fails and you decide to build a nuclear engine, it's not going to work.
That's
There's
not gonna
there's
work. You
nothing
need
you could
completely different team, completely different everything. Yeah.
you basically bankrupt one company and launch another one. So the ability to pivot is actually this very important point that a lot of people are not paying attention to. The ability to pivot in software is close to unlimited. The ability to pivot in hardware and deep tech is very, very, very narrow.
Right. And I think that's a lens that's important that you've identified that I haven't heard from anybody else. That is, if the capital allocation decision you're making is in something which has a lot of technological risk of, can you even build the product? And, is there a pivot out of this product? You might want to think differently or spend a little more time on the technology risk there than if you're talking to somebody that could have an easy pivot. I'm a software investor. I would say at least 50 of the companies that I've invested in after I wrote the check have pivoted to some extent. Sometimes a soft pivot into like a different vertical market for their product. Sometimes a super fucking hard pivot. For example, one company I did, it started as a generative AI search company, basically helping you show up better in ChatGPT and Claude. And now
Mhm.
they're a data company selling proprietary data sets to LLMs. Completely different.
That's a lot of a pivot, though.
That was what I call a hard pivot. But
Yeah, I
luckily
agree.
for them, it still fit the CEO's network, their superpowers. and the customers pretty well. They're actually doing more revenue as a data company than they were as a generative search company. And what happened in generative search is that it was a good idea, but it got overfunded and too much competitive. That's the other thing in software. You can have 100 companies funded in like 3 months doing exactly the same thing. And in deep
Hmm.
tech, you're unlikely to have 100 companies doing exactly the same thing because the researchers that have been working on this for 10 years, there's only like 3 labs that are even anywhere near it. And so in some ways, it's a little bit easier to understand the competition in deep tech. Would you say that?
I think so, especially if you're willing to spend time and effort in understanding the scientific landscape. If you're willing to, if not read the whole corpus of the scientific papers on that, then maybe at least have an expert. If you don't have any of those, then maybe at least read a summary of what's going on in this area. The the problem with that approach is it's a little bit like boiling the ocean because you can surely you can look at the direct things, but you yourself mentioned that this company that does the inflammation device for your head, the competition is not just another neuromodulation device. It's pharma, is this, is that, is
Yeah.
surgery, it's healthy food. Like a lot of people are damaging themselves just through eating habits. So you can get a very good understanding of what is the landscape of science around that particular problem if you're willing to put in the time.
Yeah.
And the landscape of science does not change it with the same velocity as landscape of software changes. So if something was true about specific things in energy storage 10 years ago, it will still stay true right now. If there were specific challenges around ways to generate energy, I'm not going to name any names again, but like there is a bunch of companies that are trying to utilize a very well-known microscopic effect in physics that on surface gives you unlimited energy. In reality, it does not. But they think that they figured it out. Like generations after generations of physicists were trying to make this thing generate energy
Perpetual
and they
energy
failed.
machine. Yeah. Mm.
And then now somebody who never had a physics degree has figured it all out,
Yeah.
clearly.
Yeah.
So you need to have a very good footing there.
Okay. Well, I think I understand a lot of the frameworks that you use. If you had to summarize, 2 or 3 repeatable lenses or portable rules that people could use to, make capital allocation decisions in deep tech, what would those be?
I will start with the fact that deep tech is such a broad moniker
Yeah.
for so many different things that I don't have a good advice on a broad deep tech. I would also mention that VC of early stages, and I mean friends and family, pre-seed, seed, those three stages of funding versus A or B are very different versus C and later are also very different.
Yeah.
VC is way less of a uniform, homogeneous industry than people think it is. In reality, it's a very dispersed industry. And like things that work for Series B fintech startup don't work for pre-seed pharma or Series A deep tech. So the very first advice I'm going to give to everybody, although it is a generic advice, don't take at face value all the advice that you see online and try to understand how it applies to your specific industry and your specific stage.
Right.
When it comes to deep tech in general, my general, very broad advice would be understand the technological competition and understand the scientific foundation of what's going on. Because a lot of people who understand how biology works would have never invested in Theranos.
Yes.
And this is a great example of
And in
when
fact,
a lot
nobody
of,
did. Nobody who understood biology did. It was all sort of name brand Hollywood people and whatever. And that was one of the problems with the company is that the people who understood it, and I think even, who's that doctor in Austin that was asked to be chief medical officer and he looked at technology, said this doesn't work. Plenty of people who looked at who did understand it said this is snake oil. They knew it was snake oil way before the market did. Yeah. So
because
so understand
I
what
don't know,
you're you're
I don't know if she was like deliberately fraudulent. I wouldn't go like that way from the get go. Maybe she was really optimistic, but at some point she knew it doesn't work and she continued selling that. And that's a problem.
so let me ask you that as the final question. How do you I always have what I call a discount rate I apply to CEOs claims and all of this stuff. And, sometimes you hear people like Elon Musk saying, "We're going to Mars," and my discount rate on his going to Mars is quite significant. But the reality is that he's actually pushed the limits and gotten things done with a really high bar like that many other people haven't. Many people's bar isn't high enough, right? But how do you risk adjust that? And at some point, if I think the person's lying to me, I'll pass. If I think they're being optimistic, but have a reasonable path for the next 3 or 6 months to make progress on their big goal, I might be a yes. But the minute I think that their optimism is in the realm of charlatanism or lying, and that's happened to me. I had one of my CEOs, create a bot farm to drive his traffic up and lie about his traffic. That's going to happen to you as an investor sometimes where the CEO, in fact, goes into the fraudulent category. But how do you think about getting comfortable with this, optimism versus pragmatism thing at an early stage VC? You want a lot of optimism, but you also want pragmatism. How do you think about that?
I think that people who are not optimists by nature will never be a good founder because
Yes.
you need to be a little bit insane thinking that you understand this world better than anyone else, thinking that you found a solution to the thing that a lot of people were trying to figure out for a while. And look, it does work every single time. Not every single time. It does work sometime from time to time. And you get companies like Uber or Facebook. By the way, have you heard about this new round announced for Travis?
Oh yeah, the atoms. Yeah.
Atoms, yeah.
Yeah, he
That's a
raised
grand vision, by the way.
1.8 billion or something like that. Good for
Yeah,
him.
yeah, that from Goldman Sachs and JP Morgan, led by A16Z. Kudos. I would say that if a person is lying about anything knowingly, and it's a very, 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 very strong signal not to do business with that person.
Yes.
If the person is delusional about something to the degree that that person doesn't hear any feedback, that's also probably a pass. You have to be a little bit delusional to be a good founder. You have to believe that you and your team will persevere, overcome, will achieve. There is no way you can be absolutely sane and rational and be a successful founder at the same time. So the big question is, where do they lie to themselves? In what specific area? Do they lie to themselves, or where do we lie to ourselves, Martin, as founders of our own firms? Is it in the area of I can do the blood test from a single drop of blood of any kind of disease, or like I can build a fusion engine the size of the tabletop? We've talked about this example in person previously. When people are delusional about reality of things, like scientific hard reality of things, then maybe it's also a pass because you don't want to deal with people who are not ready to accept the world with the physics of the world. However, when people are delusional the about how big they can become and how great they can become, those are specifically the founders that you want to invest in. When people already are when people believe in themselves to an extent that they think they can overcome anything, and yet at the same time they have this beginner's mind or this mentality of a person who's open to any advice and any questions, this is the perfect combination.
I agree, and that's what you want to find in venture. Like when you meet it at our stage, pre-seed, it should sound a little crazy, but it should have a reasonable, like if it works, everybody should love it. It's like Airbnb. They pitch like people are going to rent people's couches, and it sounded fucking crazy. But you know what? If they did rent people's couches, it could be a very big business and you could really disrupt hotels. And in fact, it did. And
Yes,
Travis's first thing on Uber, like, we got plenty of taxis. Why is the market going to be bigger? Well, because, geolocation and whatever is going to make the market for ride shares 100 times bigger than the market for taxis. And it was a little bit delusional, but he was right. And he just found the people that agreed with his delusion a little bit, but it was based on reality. The reality that unlocked Uber was the GPS chip in a cell phone that allowed you to locate somebody, and that was a technological opening that allowed you to build something that you could never build before. And so it was optimistic and aggressive, but it was unlocked by something real in the world.
Yes, and this is a great example. If, for example, Travis, when he was building Uber before GPS was in every cell phone, and he was
It's a fail.
hoping that something would change, it's a fail.
It's a
But
fail.
he believed in something that a lot of people would call delusional. He believed that he can wrap the whole country and regulations and whatever around his finger, and he will find a way to not build a taxi company, but build an information company. And he
Information
figured
company.
out a way to do this.
Yeah,
You
exactly.
can, like, human systems are malleable, whether
Yeah.
it's
Okay.
governments
Okay.
or industries or relationship. Real physics of real things is less malleable.
Yeah. And that's a key insight I've gotten from you, and I appreciate that. Thank you, Arkady,
Thank
for
you.
the time. Where can people find you and communicate with you? Are you on Twitter? Are you on LinkedIn? Where?
LinkedIn is the best.
LinkedIn. Okay. Well, thank you for this.
Thank you.
I will wrap it up here, and I look forward to talking to you next time I come down to San Francisco.
Appreciate you, Martin.
All right.